Hello, everyone. Thank you for attending today's webinar. I'm also joined today by one of my colleagues, Chris Derides. Chris is the Deputy Chief Economist, and he's graciously agreed to curate your questions. So feel free to fire away on the Q&A, and he'll pose those questions to me towards the end of the conversation. In fact, I'll speak for about 40-45 minutes, go through some slides, and then we'll go to your questions and comments. So looking forward to that. And thanks, Chris. Chris, as many of you may be aware, Chris is along with Ryan Sweet, one of my two colleagues that joined me on Inside Economics. It's our podcast that we've been doing now. Hard to believe, Chris, but I think it's like 7 months we've been doing it, and we do it every week. Heather, who's producing today's webinar, indicated that if you go to the resource button, you should see a resource button, you'll find a link to Inside Economics. So a lot of what we're going to talk about today on this webinar, we chat about on the podcast as well. But thanks, Chris, for participating. Appreciate that. Okay, to the show, to the webinar. It's very simple, 2 parts. Part 1, I'm just going to give you a sense of the baseline outlook, the most likely outlook for the economy in the middle of the distribution of possible outcomes. This is our baseline. And then part 2, going to turn to the risks, and I'm going to focus mostly on downside risks. I think that's still apropos, but I'll end on a positive note on an upside risk, just to round things out a little bit, and then we'll turn to the Q&A. Okay, so let's just dive in the baseline. I think this first chart nicely shows where we've been and where we're headed, or at least where I think we're headed, again, in the middle of the distribution of possible outcomes. This is employment, jobs, millions, going back to the start of 2019 monthly data, all the way through the end of 2024. So I'm giving you a few years of forecast as well. You can see the recession, the pandemic COVID-19 recession, very severe back March, April of last year. We lost 22 million jobs. Unemployment got to about 15%. Peak to trough decline in GDP, real GDP, the value of all the things that we produce was about 10%. So 10% peak to trough. For context, in the financial crisis, which I thought was a doozy back a little over a decade ago, real GDP peak to trough fell about 4%, so kind of gives you a sense of magnitude. We've been recovering ever since, a lot of it driven by the massive monetary and fiscal policy support. The Fed obviously very aggressive early on in providing various credit facilities to keep financial markets operating, lowered short-term rates to the zero lower bound, but engaged in aggressive quantitative easing, bond buying to keep long-term rates down. And on the fiscal policy side, we've gotten all in, by my calculation, just over $5 trillion in fiscal support, beginning with the CARES Act back in March of 2020 and extending through the American Rescue Plan, which was passed into law under President Biden in March of 2021. A lot of other support provided along the way, but $5 trillion or 25% of GDP roughly in total. Again, for a little bit of context, back in the financial crisis, if you took all the fiscal support during the crisis and immediately after, before policy turned to austerity, the support then was about 10% of GDP, so a lot of support. You can see where I think things are headed. Forecast is the shaded part of the chart. A few key assumptions here. First, that we've achieved what I'm calling herd resistance. This doesn't have any kind of official definition. I'm just using this as a way to describe the assumption that the pandemic is, obviously still raging, but it is slowly winding down, that each new wave of the virus is less disruptive, at least from an economic perspective, than the previous wave. So the Delta wave that we've been suffering through it's been disruptive, and I'll come back to that in the context of the risks. But it's done economic damage, but it's done less economic damage than the wave that struck back at the start of this year, and obviously the initial waves of the virus when there was so much uncertainty. So I'm assuming that, and this is a key assumption, that the pandemic steadily winds down. Vaccination rates continue to increase, get more therapeutics, figure out how to mitigate the virus. It's not going away, and there'll probably be more waves, but they'll be less disruptive. I'm also assuming more fiscal support to the economy, some variation of what's being debated in Congress. Currently, the Biden Build Back Better agenda, kind of on the table, is a $550 billion 10-year public infrastructure plan, and then a $3.5 trillion, let's call it social infrastructure plan. It's a range of support for different social programs, from education to housing to healthcare to childcare to climate change. The $550 billion package that has bipartisan support, the $3.5 trillion social infrastructure package, will be done under reconciliation with only Democratic votes. Now, I don't think that entire package is going to ultimately get through. So we're assuming the $550 billion package does, and $2.5 trillion reconciliation package finally makes its way through the legislative process, gets signed into law by the end of October, going into November, and is implemented in early 2022. And that does provide some support to the economy beginning in late 22, going into 23, but particularly in 24 and 25. That's the peak of the impact from that plan. And it also helps to support longer-term economic growth, which I'll talk about in a few minutes in the context of the risks. In terms of monetary policy, the support is now starting to fade. The Fed ended its credit facilities towards the start of this year. It's just about ready to begin winding down its quantitative easing, its so-called tapering QE. Looks like that probably will begin in November. They're buying $120 billion every month in Treasury securities and MBS, mortgage-backed securities. That'll get wound down steadily and come to an end by kind of this time next year. And then if everything sticks to the script, certainly the script I'm showing you here, the Fed will begin to normalize short-term interest rates just about the time the economy pulls into full employment. And you can see in the chart that would be in our baseline sometime early 2023. Full employment would be something consistent with the unemployment rate in the mid-threes, kind of sort of where we were pre-pandemic, and somewhat higher participation rate. Pre-pandemic, we were well over 63% labor force participation. I don't think we're going back there just because we've got a lot of boomers retire early, and they're not coming back, I don't think. So full employment would be consistent with a participation rate that's probably just south of 63%. But we expect that by early 2023. Just as a point of interest, to get from here to there by early 23, that will require the economy to generate something like 500,000 jobs every single month on average. Some months it'll be softer, like last month because of Delta. We only got 250,000 jobs roughly. The month before that, in July, we got 1 million jobs, but that was before Delta. So, I think there's going to be some ups and downs and all arounds here, thus the windy road to recovery, but about 500,000 jobs, per month. Just to round things out on the baseline, I know there's a lot of interest in the path for long-term interest rates. That is also critical to the outlook. And here there's a obviously forecasting anything is tough, but forecasting long-term interest rates is particularly intrepid, but here it goes. The 10-year Treasury bond today is sitting at about 1.5%. It's up a little bit from where it was a few weeks ago. We expect the 10-year Treasury yield to end this year at 1.75%. I'm rounding, obviously, but, orders of magnitude. 2.5% by the end of 2022, 3% by the end of 2023, and by mid-decade, when the economy's in full employment, inflation's at defense target, the world's economy's in equilibrium, let's say, the equilibrium 10-year Treasury yield should be about 3.5%. So that's where I think it's going to settle in. Its funds rate will be closer to 2.5%, so you have a spread between the two of about a percentage point, about 100 basis points. If that's the path for rates, that does suggest that the yield curve, the difference between long rates and short rates, will become even wider here over the next 12 months. So for a lot of you in the financial system where yield curves matter in terms of margins and profitability, I think you'll be able to enjoy a somewhat wider yield curve here. Okay, that's the baseline, most likely scenario. I do want to say one more thing about the baseline before moving on to the risks. And that is, there will be some longer-term consequences, and I run the risk of overhyping the Inside Economics podcast, but here goes. Last week, in the last week's podcast, we did talk about some of the longer-term consequences of the pandemic. I think Chris, you focused on demographics, very important impact on demographic trends. Ryan, he focused on debt, sovereign debt, and corporate debt globally. Nervous about the increase in indebtedness and what happens when interest rates do rise. Again, I'll talk about that in the risks. And then I talked about remote work, and I do think this is a very significant shift, long-term consequence of the pandemic that has all kinds of economic implications, and you can kind of get a sense of that here in this slide, which shows net out-migration from urban cores across the nation's 400-plus metropolitan areas. This is monthly data going back to the start of 2007. The last data point is for August. This is based on credit file data. We get a 10% sample, random sample of all the credit files in the country from Equifax every month. And it's anonymized, obviously, but we can see addresses, and so we can look at address changes. And based on that data, we can identify, where people are moving from and moving to. The shaded part of the chart represents when the pandemic hit. And if you look pre-pandemic, in the 12 months leading up to the pandemic, net out migration from urban cores, that's the number of people moving out of urban cores to suburbs, exurbs, and rural areas, less than the number of people moving into urban cores, was somewhere south of 300,000. Currently, as of August, again, the last data point, 600,000, so more than a doubling in the net out migration. And you can see in the chart the top 10 areas that have suffered the biggest increases in net out migration during the pandemic. No surprise, New York and a number of other major areas in the northeastern corridor, Boston, Philly, our hometown, and D.C. On the West Coast, big California metro areas, L.A., San Francisco, Seattle. I think Miami is in there. Yep, there's Miami, Chicago. And you'll notice that it looks like the net out migration is topping out, but the other thing you'll notice is it's not really rolling over. It remains very elevated, and I think that does go to the increasing prevalence of various forms of remote work. And I do think as technology improves and HR departments figure out how to empower remote work, we'll see more of it. Given how tight labor markets are and likely to remain, given demographic trends going forward, even on the other side of the pandemic, I do think workers have kind of the upper hand here in negotiations with their employers, and one of the things they're going to demand is the ability to work from wherever they want to work. So this is a trend, a phenomenon that's here to stay. It has obviously important implications for regional economies. So these areas shown here in the chart, they suffer as people leave, and then of course the areas where they're going benefit. So folks from the Northeast are going to Atlanta and Charlotte and Tampa and Jacksonville and Orlando and Austin. And folks leaving Seattle and the Bay Area and LA, they're moving to Boise and Phoenix and Tucson and Vegas and Denver and Salt Lake City. So those areas really benefit, and you can see it in the employment data, you can see it in the house price data and housing demand, which we'll come back to in a few minutes. So I do think the pandemic, as they say, will have a long tail, and one aspect of that long tail will be increased remote work. Okay, that concludes part one, the baseline. Hopefully you got a pretty good sense of it. I think fair to say that optimistic about the economy's prospects. In fact, just to strike that point home, between the time when the pandemic hit to when the economy returns to full employment, gets back to full swing, will be about 3 years. So got hit early 2020, we'll be back to full employment by early 23. 3 years. Typically, if you look at business cycles since World War II, it takes about 6-7 years for that to happen. And of course, in the expansion after the financial crisis, it took us almost 10 years to get back. A lot of scarring after, so-called scarring after the financial crisis, not so much after the pandemic. So it's a relatively upbeat, optimistic baseline outlook. However, being the good economist I strive to be, there's obviously a lot of risk to this. So, part two, what could go wrong? And just to kind of encapsulate, there are obviously many risks, but just to kind of put it into some kind of relief and context, is this what we call risk matrix. This is for the United States. Yes, we do this for many countries around the globe, varies country by country, but this is for the U.S. Just to acclimate yourselves to the matrix, the x-axis, the horizontal axis is the severity of that risk or that shock. And this is kind of like there's a time dimension to this too. It's kind of like a present value of the expected loss if the shock were to occur. So if it's a severe shock and it's more likely in the near term, that's a big deal. So for example, the Treasury default, you can see that's all the way to the southeast part of the matrix. While that has a low probability of happening, and that's the horizontal axis, the severity of that shock would be very, very significant. I'd even put it in the category catastrophic if the U.S. government actually defaulted here, and we'll come back to that in a minute under the risks. As I mentioned, the vertical axis is the likelihood of the shock. Obviously very subjective. So if you look at the kind of the northwest of the matrix, forbearance cliff, this is hearkening to the fact that many of the government supports that were provided during the pandemic to help borrowers and debtors kind of manage through are expiring. There's a mortgage forbearance for borrowers of FHA, VA, Fannie Freddie loans. That's starting to wind down. There was student loan payment forbearance. I believe under current rules that's going to expire in January. There's moratoriums on foreclosure for those government-backed loans. And, of course, the rental eviction moratorium, that ended about a month ago now when the Supreme Court ruled that the federal rental eviction moratorium was unconstitutional, so that has ended. If you go back, I don't know, 6 months, certainly 12 months ago, I would have thought the forbearance cliff was a much more significant risk to the economy. Many more borrowers, households were under financial pressure, and if they hadn't gotten that support, we would have seen many more credit problems, many more foreclosures, many more defaults, and that would have more economic damage. But at this point, much less so. We've kind of worked through a lot of the problems, and people are getting back on their feet financially. So this clip it's going to happen. So very high probability, but the severity of the shock is very low. Finally, just the obvious is in the northeast part of the chart. The biggest, most significant risk with high likelihood and high severity is, well, we're going to have another wave of the pandemic. That feels like the message we learned from Delta. Unfortunately, if you go back when the vaccines were being rolled out earlier this year, there was a lot of optimism, and I was optimistic myself, thinking that perhaps this was the end of the pandemic. We'd not suffer any more material waves of the virus. Well, the Delta wave put an end to that hope, and I do think it's appropriate to think that there will be other waves of the virus. Again, I'm assuming in the baseline that each wave of the virus is less disruptive to the economy than the preceding one, but obviously a lot of risk around this. So I'm not going to go through all of this, and it's changing very rapidly. You can see a government shutdown there, and that's already changed since I did the chart. There's a lot of this is moving all the time and evolving. So I'm not going to go through it all. But if you have any questions about it, feel free to post them. Okay, so let's dive deeper into some of these risks, and I'm going to go through a handful of downside risks. And again, as I mentioned earlier, I'm going to end on an upside one, just to because there are upside risks, and I think it'd be therapeutic and on a positive note, and consistent with the overall message of this webinar. Risk number one, the pandemic. It's still raging, it's still doing damage. The Delta wave variant of the virus has done damage. You can see that in lots of different ways, one of which is I'm showing you here. It has impacted sentiment, consumer sentiment. I'm showing two measures of consumer sentiment. The blue line is the Conference Board survey of sentiment. The green line is the University of Michigan survey of sentiment. This is monthly data going back to 2019, start of 2019, and we got the September value from the Conference Board. I haven't gotten it yet for University of Michigan, I don't think. Or no, maybe we did since I did this chart. And I think it's kind of very consistent with the last data point here. Maybe improved a little bit, but the broader point is you can see that sentiment got not surprisingly crushed when the pandemic hit back in early 2020. Had slowly recovered, and then Delta hit, and sentiment has fallen off quite significantly. Interestingly enough, the University of Michigan survey, at least for August, that was a pandemic low. The Conference Board survey has held up and has done better. Some of that goes just to the types of questions that are asked in the surveys. The Conference Board is more labor market oriented, and labor markets have performed very, very well. And so the blue line has done a little bit better than the green line, which is more around personal finance issues. But both show that Delta has spooked consumers. Going back to my point that I think people were hoping that with the vaccines this thing was over, but those hopes have been dashed. You can also see it in spending. The impact of the Delta variant on spending. Air travel has fallen back a bit. Restaurant bookings are down a bit. People have pulled back a little bit on getting out there. That more people have been sheltering in place. You can see that the supply chains, obviously global supply chains have been severely disrupted by the pandemic, and they're just now more jumbled as a result of Delta. Delta really nailed Asia, particularly Southeast Asia, and a lot of the supply chains begin there, particularly the chip industry. A lot of chip plants in Malaysia, for example, they had to shut because workers just were too sick. Various ports, terminals and ports in China were shut down as the Chinese have the no-tolerance policy with regard to the pandemic and shut things down, and that really has further exacerbated the supply chain issues, created more shortages, disrupted the vehicle industry. There's simply no inventory, and that's crippling sales. hurting the construction industry, home building, because of building materials and appliances. So it's really hurt, significantly. It put more upward pressure on prices, adding to inflationary pressures, which I'll come back to in a minute. But the risk here, and again, my assumption is that the pandemic will continue to wind down, but the definitive risk is that the next wave is actually more of a problem. It's more contagious, more virulent. Obviously, if it eluded our vaccines, that would change the ballgame here. So, risk number one is the pandemic itself. Risk number two is fiscal policy. Got a little bit of good news in the last week. The administration, Congress came to terms on providing short-term funding for the federal government so that it could continue to operate for a couple more months before it needs more funding, avoiding a government shutdown. But two things on the docket here that need to get ironed out pretty quickly. The first is the debt limit, and there's a lot of brinkmanship around this going on. I don't know if you're following kind of what's going on in D.C., but Republicans and Democrats are really battling over this debt limit. Republicans are insisting that the Democrats figure out a way to increase the debt limit on their own. Democrats are arguing that they can't do it, at least not without the Republicans kind of stepping aside and not filibustering efforts to suspend the debt limit. Republicans are insisting that Democrats can. They can include it under the reconciliation legislation, pass it. In that case, they'd have to, because of the reconciliation rules, they can only increase it. They can't suspend it, but they could do it on their own with only Democratic votes. So the brinkmanship here is very high. And brinkmanship around debt limits, it does damage. It's not costless, even though at the end of the day, lawmakers have at least historically figured out a way to increase the debt limit. You can see that here in this slide. This shows the the 4-week U.S. Treasury yield, the Treasury yield on U.S. Treasury securities, 1-month T-bills. Back in the 2011 debt limit kerfuffle, and then in the 2013 kerfuffle, T is the drop dead date for raising the debt ceiling. So you can see in the period leading up to that drop dead date, T-bill yields rise because the folks that have that 4-week bill are pricing in the probability that they may not get paid on time, and that would wreck their return, and so they jack up the yield as you approach that drop dead date. Same thing is starting to happen now. I think yesterday the 4-week T-bill yield had risen about 7-8 basis points from where it was just a couple weeks ago. So not quite to where we were in 2011 or 2013, but my guess is we'll get there, because I don't think lawmakers are going to nail this thing down until we get to the drop dead date. Now, there's a lot of uncertainty around exactly when that's going to occur. Janet Yellen, the Treasury Secretary, has identified October 18th. CBO says no, probably later in the month, maybe even as late as early November. We're estimating, Bernard Yaros and I did a paper on the debt limit that you can find if you go to Economic View or you Google it, Zandy debt limit, you'll find it, that the drop dead date is October 20th. There's some big Social Security payment due on that date. But because of the uncertainty around the timing of when the Treasury receives its tax payments and outlays because of the pandemic, the scrambled kind of timing of outlays, and of course assistance related to Hurricane Ida and other and fires, the federal government assistance fires, hard to know when checks are going to get cut, so that makes things very complicated. Now, my baseline here is obviously that lawmakers will settle this in time before the government actually defaults, probably through the reconciliation process. But I'd have to say there's not any inconsequential risk here that there's a misstep and we might actually see a default. If it's a day or two, I think we see turmoil in markets, and that would be what we require to get lawmakers to act quickly, which I think they would. But if they don't act quickly for whatever reason and they get bogged down, and let's say this thing drags on to November or so, like say Thanksgiving, let's say, that's kind of the scenario we considered in the paper I mentioned. That would be the fodder for another recession. So a lot of risk around this. The other aspect of what's going on in D.C. is around the Build Back Better agenda. I mentioned this earlier. A lot of different scenarios on how this may play out, and just to give you a sense of what it means for the economy under these different scenarios is the unemployment rate, which I'm showing you here. This is quarterly data from Q1 2019 through the end of 2024. You can see where I think full employment is. As I mentioned earlier, that'd be consistent with an unemployment rate in the mid-threes. This is based on simulations of our model of the economy, the global economy, of the macro economy. The blue line represents the unemployment rate if there had been no additional policy under Biden. So let's assume no American Rescue Plan. That's the plan, the $1.9 trillion support package that got passed in March of 2021. And you can see if we had not gotten the ARP, the American Rescue Plan, the economy would have struggled this year. Unemployment would have hovered around in the high fives, close to 6%. It would ultimately have fallen as the pandemic wound down, but it would have been a more painful kind of scenario. The red line represents the unemployment rate if no additional support is provided. So we got the ARP, it helped push unemployment down. We're now at 5.2% on the unemployment rate. But what if we don't get any additional support? You can see it kind of goes sideways here, at least in terms of unemployment, the economy doesn't get quite across the finish line to full employment. The green line, that represents our baseline. So we had the American Rescue Plan, the ARP. We get the $550 billion infrastructure plan that's bipartisan. And then we get a $2.5 trillion reconciliation package, that's the social infrastructure. And that kind of lands the plane, the economy, right on the tarmac. The green line kind of just goes to full employment, and that's the optimistic baseline scenario that we have. By the way, the $2.5 trillion is kind of the midpoint of the current $3.5 trillion on the table, and the $1.5 trillion that moderate Senate Democrat Joe Manchin from West Virginia said he's willing to vote for. So I'm assuming that 3.5, 1.5, compromise 2.5. At the moment, it feels like it might be a little smaller than that, closer to 2. But we're still assuming 2.5. We are assuming some pay-fors here, some tax increases on large corporations, and kind of rolling back some of the tax cuts for large corporations and the well-to-do, high-income, high-net-worth households that'll pay for of the $3 trillion in total support, the $550 billion infrastructure, the $2.5 trillion reconciliation, roughly $3 trillion. We're assuming about $2 trillion of that is paid for, so that leaves a budget deficit. These are all over 10-year periods, budget horizon of the CBO. Leaves a budget deficit of about $1 trillion or about $100 billion per annum. But the green line is kind of the optimistic baseline. I did, though, run this scenario where we get what's on the table now, the $3.5 trillion. And you can see that's the gray line. The unemployment rate actually falls through the full employment unemployment rate. And I would say that does run the risk of generating inflation that is uncomfortably high, will cause the Federal Reserve to tighten monetary policy more than we're anticipating. And that is the fodder for a more kind of classic business cycle, an overheating economy. So I do think, lawmakers do have to essentially thread a needle here. They don't want it to be too small, but they don't want it to be too big either. Otherwise, you run the risk of overheating. I will say, and I didn't show it here, but I do think the infrastructure plan, the reconciliation package, if passed, will help to support longer-term economic growth. The infrastructure plan mostly through somewhat stronger labor productivity. It's small, but small positive. And the social infrastructure plan around higher labor force participation, mostly because it provides support for child care and elder care and disability and paid family leave, which should help to support higher labor force participation, particularly among female workers and lower income households, families of color, where participation rates are relatively low. So it does provide some long-term benefits. Of course, the climate change does address an issue that I do think is going to have significant longer-term implications for the economy. But nonetheless, a lot of risk around that. So that's risk number 2. Risk number 3 is inflation. I'm not going to dwell on this. I am expecting that inflation will moderate, that it is transitory, as the Fed would say, that it is related to the pandemic. As the pandemic winds down, as I anticipate, global supply chains start to iron themselves out because of the higher prices. Businesses respond by ramping up capacity, investing more, which they appear to be doing. It takes a little bit of time, but by this time next year, certainly as we move into 23, inflation moderates and close to the Fed's target, which is for the core consumer expenditure deflator inflation, that's excluding food and energy prices, be just north of 2%. And I think that's where we settle, roughly by the spring of 2023. But, obviously a lot of risk around that. In addition to the pandemic, I could be overly optimistic about how quickly these supply chains, kind of work things through. I could also be overly optimistic about how quickly the labor market kind of adjusts. There's 11 million close to open job positions, and that's a record by orders of magnitude. You have to go even before the before the pandemic, when the labor market was tight. We had 6.5, 7 million open positions. So we got to fill those positions, and if we don't, then that means higher wages and higher inflation than I'm anticipating. Now, again, I do think the pandemic is behind. Why it's taking longer for workers, available workers, in and out of the workforce to take those open positions. Taking care of kids, taking care of elderly family members, worried about getting sick. There's a lot of issues related to the pandemic, and that they'll iron themselves out as the pandemic winds down. But a lot of risk around that as well. So inflation could be more of a deal than I'm anticipating. That's risk number 3, downside risk number 3. Downside risk number 4 is asset prices. They're juiced up. They're pretty lofty. Valuations are high. You can see that in the equity market here, the stock market. This is my favorite measure of valuation. In the stock market, this is kind of like an economy-wide price earnings multiple. The numerator is the value of all publicly traded stocks as measured by the Wilshire 5000. The denominator is economy-wide corporate earnings. I've got data back to the start of 1980. The last data point is for the second quarter. For the second quarter of 2021, a little bit lag. And you can see the PE multiple by this measure is back to where it was in late 90s, early 2000 Y2K. Y2K, that was a bubble. I don't think there's any debate about that. I don't think the current high valuations signal a bubble today. I mean, there is speculation creeping into the equity markets and asset markets more broadly. GameStop, meme stocks, SPACs are all symptomatic of that. But, valuations should be high given how low interest rates have been and how low they're expected to remain. But regardless, I think valuations are high. And I do think the correction, stock prices have gone kind of sideways here for the last several months, in part because interest rates are starting to push a little bit higher. I do think in our baseline we have stock prices essentially staying flat here for another year, 18 months. Let corporate earnings catch up. Let it adjust to the higher interest rate environment that I'm anticipating. But I do think there's a lot of risk around this. We could see a much more significant correction in equity prices for a much more sustained basis, and that could do some damage to the economic recovery that I'm anticipating. As I mentioned, other asset prices are juiced. In addition to equity prices, the fixed income markets are juiced. Credit spreads in the bond market are very thin. Obviously, what's going on in the crypto markets. And then, of course, the housing market is also feels really juiced up. You can see that here in this map of the country. This is for the 100 largest metropolitan statistical areas across the country. Here, what we've done is calculated price to rent ratios. Again, kind of like a price earnings multiple. So the price of the home in the numerator the effective rent in that area in the denominator. In the long run, the price-to-rent ratio should be roughly consistent with its long-run historical norms, which varies quite a bit by market for lots of different reasons. What I've done here is for those areas where the current price-to-rent ratio is consistent or within 10% of its long-run historical norm, I'd say that's appropriately valued. They're in green. Those are metropolitan areas that are in green. So my home, Chris's home in Philly, you can see where Philly is. That's in green. Our home is appropriately valued, at least by this measure. If your area in orange, your PR ratio, your price-to-rent ratio is about 10 to 20% above historical norms, so you're overvalued. And if you're in red, well, seriously overvalued, more than 20% by this measure, mostly in the West and in parts of the South. This is not meant to be an indicator that's proof positive. It's, I wouldn't rely on this by itself, but this is a good kind of screen. If you're in orange, certainly in red, it's saying, hey, come look at me, what's going on? Is there a reason why prices are all juiced up relative to rents by historical norms? Nationwide, it does feel like prices are, again, I wouldn't call it, it's not a bubble, it's not speculative. You don't see the kind of flipping that we have historically. The mortgage lending has been very responsible. Credit scores on mortgage loans have remained very high. So I don't think this is anything comparable to what we saw, let's say, prior to the financial crisis. But nonetheless, as interest rates rise, I think some of these markets, particularly the red markets, are at significant risk of, if not prices going down, certainly going flat for a while, and I'd be expecting some price decline. So something to watch. I don't think this is existential by itself to the economic recovery, but it is a big enough risk that it could change the contours of the economic recovery. Certainly, some of these markets around the country. Finally, risk number 5, downside risk number 5, the increase in debt, particularly sovereign debt. As governments across the globe have followed the same policy prescription, borrowed a lot of money to help support their economies, and I do think with the leveraging up, as interest rates do normalize and rise, that will create some problems, and we could see some real stress fault lines in sovereign debt. Similar kind of dynamic in corporate debt, not everywhere. I don't think that's as big an issue here in the U.S., although, it's something to watch. The leveraged loan market has been very active, but it's a much bigger deal in other parts of the world like China. Just to explain this chart, the x-axis is the debt-to-GDP ratio for sovereigns as of the fourth quarter of 2020. The y-axis is the so-called concept of fiscal space. That's the difference between the actual debt-to-GDP ratio and that debt-to-GDP ratio that we estimate to be above which investors begin to lose faith that they're going to get paid in a timely way, jack up interest rates, and get into this kind of self-reinforcing negative cycle. And you can see a number of countries, particularly in the emerging markets, Russia, United Arab Emirates, some developed economies. You can see Spain, Italy, Japan, very close to that zero fiscal space line. So that means that some of these economies are at significant risk of suffering some kind of event, maybe even a crisis, a sovereign debt crisis, as rates rise. Not, I don't think this year, next year, but as rates normalize towards mid-decade, this will become, I think, more of an issue. Finally, let me end on a positive note. I said I would, and I do want to highlight what I consider to be the most meaningful upside risk to the outlook, and that's productivity growth. I'm showing you non-farm business productivity growth here, quarterly data back to 1990. Last data point is the second quarter of 2021. The blue line represents the year-over-year growth in productivity. The green line, the 5-year annualized growth, just to smooth out the volatility that gets the underlying trend. You can see that productivity growth really did slump in the expansion after the financial crisis. Just for context, between World War II and the financial crisis, non-farm business productivity grew about 2% per annum, almost on the nose. Some at times a little stronger, other times a little weaker, but on average 2%. In the expansion after the financial crisis, the decade after, it was about 1%. But look at it now; it's been migrating higher. It's closing in on 2% again. Now, some of that may be just cyclical. Some of it may just be measurement. You can see during, when you come out of recessions like you did after the financial crisis or after the pandemic, you get this pop in productivity growth for various measurement and actual more fundamental reasons. So there may be a cyclical element to what's going on here, but it does feel like things are improving. Businesses are investing very strongly. They did so in the pandemic, and post-pandemic, that investment remains strong. And a lot of it's towards labor-saving technology, because I do think businesses realize that there's going to be severe labor shortages going forward. And in our baseline, we're assuming that productivity has improved from about the 1% pre-pandemic, in the post-financial crisis period, to about 1.5% per annum. But I do think there's a risk here, upside risk here, that it could be back up closer to 2. And I think there's some good fundamental reasons for that. And we can go into that if you're interested in the Q&A. But if that's the case, if it's 2%, that's a big deal. That has a lot to say about future income growth, profitability, asset price returns, our ability to address our fiscal issues, where interest rates are going to land. I mean, enormous implications. So something to keep an eye on, and hopefully we get that positive surprise. Okay, I covered a boatload of ground. I took exactly 45 minutes. I am going to stop and turn the conversation back to Chris. And Chris, I'm hoping that we got some questions from the group.
Yeah, we sure did. We have some great questions. Keep flowing in, so do encourage audience to keep asking away. But let's see how many of these we can get through. And I'll pick up with your last slide. One of my favorite topics is productivity. And there was a question that came in regarding reshoring of manufacturing production to the U.S. And wanted to get your thoughts on that. Do you expect to see that continue or accelerate or slow down? Or how is the productivity and the trade picture going to shake out over the next few years?
Yeah, great question. And I should say as a preface, Chris, you and one of our other colleagues, Dante D'Antonio, wrote a good paper on productivity growth, and it was kind of a point-counterpoint. And I think you were arguing that for the upside surprise here and Dante for the downside surprise. Is that right, or was it the other way around? I can't remember.
No, that's right. That's right.
That's right.
I'm the techno-optimist.
You're a techno-optimist, right, yeah. I think there's many elements to this, and one of which is, I do think we will see reshoring continue. I do think American businesses, I think businesses all around the planet, are reevaluating their supply chains given what they have been going through and what they're still going through. Those supply chains are very, very long and very vulnerable, as we can see. And, it's not just the pandemic. There's been other events that kind of highlight this risk. I mean, the earthquake in Japan back in 2011 that significantly disrupted the auto industry, for example. If that was the end of the story, I think most companies would have ignored it. But you throw in the pandemic, and I think that just strikes home the point that supply chains are long, they're at risk, they're very vulnerable, and can lead to significant disruption. Also, adding to this is the growing tension, or the very high level of tension between the United States and China. And, it seems to have abated a bit under President Biden. President Trump obviously took a very combative approach. President Biden has not stood down. He has continued to maintain the higher tariffs that President Trump put into place, and continues to engage China quite aggressively, a little less publicly and a little less combatively. But I think everyone now has the view, appropriately so, that this relationship is a bit vexed, not going to iron itself out quickly, and does pose risks to supply chains that go into Asia. And then, moreover, the administration and Congress have seen what happened with supply chains and view it as I think, again, appropriately so, as a national security issue, particularly when it comes to things like semiconductors and chips, because that goes into all kinds of everything, including military equipment and sophisticated satellites and instrumentation, and critical to national security. Sophisticated materials and machinery also, very important. So I do think the Congress administration, as part of the Build Back Better agenda, are appropriating funds to help, harden these supply chains and bring them in. So I do expect manufacturers, U.S. manufacturers and others, retailers and wholesalers to shorten up the supply chains, bring them in, reevaluate them, and I do think that will be a significant shift here, going forward. And I do think, it is an element of, the expectation with that investment that we will see some improvement in productivity. I don't guess at the top of the list of reasons why productivity growth could surprise on the upside, but I think it's on the list of reasons.
All right, great. Question about the Great Resignation. And in your opinion, is this a short-term phenomenon or is it going to linger?
I think there's both a cyclical near-term and a secular long-term element to what's going on in the labor market and labor supply issues. On a cyclical basis, I do think the pandemic has really scrambled things. If you look at the reasons why people that are unemployed or who stepped out of the workforce during the pandemic are coming back slowly, and you can get a good sense of this by looking at the Bureau of Census Household Pulse Survey, a survey they've been conducting on a biweekly basis, more or less, since the pandemic hit. And it's a great survey, very large, and they ask lots of questions, and some of the questions are around, if you stepped out of the workforce during the pandemic, why? And you can see there that, at the top of the list are taking care of kids, child care, big issue. Now, that's maybe less of an issue today than it was a month or two ago because schools reopening in person, but, child care is still an issue, for people, and schools still are struggling to stay open because of the Delta variant and the pandemic and the infections. Taking care of elderly parents, fearful of getting sick, taking care of sick family members or friends, all those things are playing a role. And, it's not until the pandemic really winds down in a more significant way. Hopefully we don't have another wave, and if we do, it's clear that it's not going to be as virulent or contagious or disruptive, and people start coming back in and going back to work and taking those 11 million open positions. So I did mention that I thought it was going to take about a year, maybe 18 months for global supply chains to right themselves. I suspect it's going to take about a year, 18 months for labor markets to kind of work through all these issues and kind of normalize, take those open positions. I do think there's a secular element here, though, too, and that is, and this is, evident, this is what you were talking about in the podcast around demographics, that even pre-pandemic, demographics were arguing for very tight labor markets. I mean, the baby boom generation, a large cohort, is leaving the labor market quickly. It left, significantly during the pandemic, and those folks aren't coming back. They were probably going to only work another year, 2 or 3 anyway, and the pandemic just accelerated all that. And with stock prices and housing values where they are, I think many boomers feel like they have the financial wherewithal to retire. So they're not coming back. And then, of course, foreign immigration, significant important source of supply, labor supply, both skilled and unskilled. That was under significant pressure even before the pandemic because of shifts in policy under the Trump administration. And, of course, the pandemic has just crushed, immigration. I do think it will start to normalize a bit under President Biden. At least allow for more immigrants to come in. But, I don't think it's going to be tough to get back to the kind of immigration we had pre-President Trump just because of demographic trends. Overseas, population growth has slowed very dramatically. And once population in the country falls close to the replacement rate population growth, immigration falls off very rapidly, and that's happening in more and more countries, emerging markets across the world. So I do think there's a very significant secular long-term issue here with regard to labor supply. I think the pandemic is going to mark at least in our timeline, in our minds going forward, a shift in the balance of negotiating power between workers and their employers. You know, up until for 30 years, 35 years between the late 1970s, early 80s through the pandemic, it was a employer's market. I think going forward, at least for the next decade, perhaps two, it's going to be a workers' market, a very, very different kind of environment.
All right. I'm going to give you a tough one as the last question here.
Sure.
Question about your employment assessment or employment impact assessment of the Build Back Better package. So whether it's a $2.5 or $3.5 trillion package, certainly that's going to provide a lot of benefits, perhaps in terms of long-term productivity, as you mentioned, but there are also a number of disincentives or potential disincentives to work, right? Higher taxes, benefits going to families or individuals, right, that might cause them to provide less labor to the market. So the question how you came up with this conclusion that employment would actually increase rapidly, and then a corollary to that is looking at the pre-pandemic employment situation, right? We had high participation, employment rate was coming down, our unemployment rate was coming down. So why would we think that introducing this new set of spending would actually improve upon that track record that we had prior to the pandemic?
Well, you make it's a good question. They're really good questions. The first part with regard to labor force participation and the impact of the Build Back Better agenda on participation, you're right. There are a lot of cross currents here. Some elements of the package would support higher participation rates. Some elements would weigh on participation. But I think the net of all those cross currents is to lift participation. And that is consistent with, let's call it a meta study of all the various academic and other research that's been done on these kinds of policies and what they mean for participation rates. Some studies found big positive effects on participation. Some saw negative consequences, but the net of that meta study, which informed our work, was that it would be a net positive. I mean, say, for example, the point about higher taxes. Well, these are higher taxes on people with very, very high incomes. And I don't think, first of all, that's a small segment of the population of the labor force. Second of all, I don't think that will have a material impact on their willingness or ability to provide labor to the labor market. That they're motivated by many other different things, and the higher tax rate isn't going to crimp their returns on that labor supply to the degree that it's going to significantly weigh on participation rates. I mean, if in fact all of the tax increases proposed by President Biden were passed, the effective tax rate on high-income households affected by the package would only go back to its long-run historical norm, meaning back to World War II. I mean, it's effectively all it's doing is rolling back the tax cuts that were implemented under President Trump, going back to where they were prior to that and where they were on average. So I don't, yes, all else being equal, that is a negative on participation, but I think it's very much on the margin. It gets more than washed out by the benefits of the support to lower income households, female workers, workers of color, where participation rates are very low, and it's very clear that they're not working because the commute costs are too high. They have to live in housing that's far away from their work because of affordable housing shortages. That the cost of child care is too high. They don't get paid family leave, so they can't stay in the workforce when something happens to them or their family. They're the main caregiver. That is much higher as a consequence of, say, elasticity than the tax rate impacts on high income households. But there's that's a lot of moving parts there, and lots to disentangle. but the net of all of that disentangling is that I think it would materially lift participation rates. It does, the Build Back Better agenda does lift employment, but only so far as it lifts labor force participation, because if you're at in an economy that's at full employment, and again I'm arguing that's where we're headed, the amount of jobs can only be equal to the number of the increase in the number of jobs can only be equal to the increase in the number of labor in the labor force. Otherwise, you overheat. So I do expect more jobs because I expect higher labor force participation and a bigger labor force. But it's not I think the word you use, large increase in employment. There's some near-term effects, because you have excess labor supply because of high unemployment and underemployment, because a lot of people step out of the workforce. So you get bigger employment effects early on, but in the long run, over the next 10 years, the employment effects, I'd say, are, they're modest. They're consistent with, the increase in the labor force. No more and no less than that. But the debate can be continued for sure.
Absolutely. Lots of complexity and lots of info. So I think we're at the top of the hour here.
Great. And yeah, I think we should. And what we'll do, like we do with all these webinars, we're going to answer all these questions. So, if you have any additional, keep firing away. Heather, the producer of the webinar, will bring them together, and I will respond to them in writing, and we'll distribute that to everybody so that everyone on the webinar can see the Q&A. So if you have questions, no need to stop posing them. Feel free to continue to post them. But I do want to thank Chris for graciously emceeing this, and to the audience for attending. And again, Inside Economics. I know, I'm hawking it. You'll enjoy it, I promise. So come and visit Inside Economics. Thank you, everyone. Take care now.